Hello, this is Trading with Confidence, and I'm John Breland. So today I'm going to talk about periodic oscillations in the market that are identified by the surge oscillator. And I'm also going to show you how these oscillations can help you identify Elliott waves that are in the market that you can't really identify with price. So let's get started. So if you look at Bitcoin and you analyze price movement, you'll see that it's not very clear that there's a periodicity in the movement of price. For example, you will see from here to here it moved up, but then a very short move down, a longer move up here. This move down here was about as long as the move up. In the case here, the move up looks to be very long compared to these moves up. Likewise with this one. So the periodicity, the idea that there's constant intervals in the market of up and down movements is just not clear from price. So, however, if you look at the surge oscillator, you will see a clear indication of a somewhat fixed interval in the motion of the oscillator. If you compare the time between these peaks and troughs, for example, you'll see that it's about the same amount of time between each peak and each trough. Even on the stochastic oscillator, you will not necessarily see a periodic movement, though if you look very closely, maybe you could see something. But with the surge oscillator, it's much more apparent. So this periodicity is very helpful for taking trades. It's basically telling you these high points and these low points are the points you want to be considering taking your trades. And anything in between is like motion of the market or some kind of movement of the market. And so that's the value of this periodicity. So if I were here, for example, in the market, and I say, okay, this thing is probably going to take about 3 or 4 bars before it moves around again. And in this case, it has 1, 2, 3, 4 bars. So 3 or 4 bars would be considered times 3 days is 12 days. 4 bars times 3 days, 12 days. So it tells me that I want to wait for 12 days or so around that period of time to consider taking my next trade. And so these periods aren't exact, but they are somewhat close enough that you can fudge it a little bit and kind of get a general idea of when it is the best time to take the next trade. So the next thing I'm going to do is I'm going to draw vertical lines that matches the peaks and troughs of the surge oscillator to show a better picture of the intervals that are in the market. So I've drawn these vertical lines across the peaks and troughs of the surge oscillator, and as you can see, the intervals between these peaks and troughs are fairly consistent, but not exactly. You'll see some areas where the peaks and troughs are a little bit wider than other areas. And this actually suggests a widening and a narrowing and a widening, which would be another higher level oscillation between the distances between the intervals. And so this is suggesting that possibly we're going to get widening intervals coming in the future. But with the surge oscillator, the basic point is that the market is broken up into these somewhat even intervals from which you can make decisions. These are all basically decision points in the market when you want to take a trade and when in areas where you shouldn't care to take your trade. So that's the value of the surge oscillator in one sense, is that it tells you, okay, now's the time to make a decision. Do you want to go long? Do you want to go short? And of course, the signals are those actual points of decision. And not every one of these lines is the actual signal. So some of the lines are an actual signal. Some of these lines are not an actual signal. So there's one thing here I want to point out about the surge oscillator giving these periodic signals where the market doesn't. And that is to show an example of what the surge is doing. So I'm going to blow this up a little bit so we can see it. Let's take this for example, this area for example. You can see that the surge oscillator has moved up between this interval as well as prices moved up. And in this particular interval, the surge oscillator has moved down. Well, the price has moved up in this particular instance. So when you look at price alone, you don't necessarily see the oscillations that are occurring. But the surge oscillator is showing you a peak here and a trough here, even though there's no trough in the market right here. So that's the feature of the surge oscillator. It helps you to break the market into pieces that you can analyze. And this feature as well helps you to determine Elliott waves that exist in the market. And we'll be getting into that part later. So now I'm going to get rid of all these lines, and I'm going to talk about Elliott waves and how the surge oscillator can help discover Elliott waves better than by just looking at price alone. So I'm going to start this by drawing what an Elliott wave typically looks like. So your textbook Elliott wave, basically you have a wave 1, a wave 2 that comes back down. This is a bullish Elliott wave. Wave 3, which is typically a strong wave. A wave 4, and then a blow off wave 5, and then there's a reaction, a three wave reaction wave, which is an A, B, and C. This, and then the Elliott wave is basically starts all over again with the 1, 2, 3, 4, 5 like that for a bullish move. So this is very easy to understand from a very basic standpoint, but the Elliott waves in the market vary a lot from this pattern. You'll see the waves in there. Sometimes you'll see 3 waves up, 3 waves down if the market's moving sideways, for example, and then you get a breakout, and then you get a 5 wave and a 3 wave correction. In this case, if you look at Bitcoin, it looks pretty obvious that you have an Elliott wave right here, which is 1, 2, 3. You could possibly say this is 1, 2, 3, 4, 5, and then a move down. So I mean that they do appear in the market, but when analyzing Elliott waves in real time with price alone, it is very difficult to really know where you are at. So let me take an example of this. So I'm going to make this very large to make it easier to follow. Move this down a little bit here. So let's take this wave, for example, right here. If you're an Elliott wave analyst, you may say, okay, this is possibly wave 1 right here. I'm going to make this very, very bold. And then you have a wave. Let's make this wider so it's much easier to see. Then you have a wave 2 here. Then you have wave 3 here. So we're talking about the market in real time. 4 here, and then 5 here. And then you may say to yourself, oh, okay, good. We have what looks to be a 1, 2, 3, 4, 5. This would be the sell area. But then what happened? Well, we had this extra move up, and people would typically they'll sell here, and this was actually a good sell in the long run, more long run. But in the immediate short term, it possibly took out stops, right? So this didn't work. So from a classical standpoint, you may think, and if you're looking at price, that is, you may think, okay, well maybe this is a wave 7 or some kind of connection wave or something like that, and so it should continue up. But this doesn't really follow the standard. The wave 7 idea doesn't really follow the 5 wave up and 3 wave down, right? So it starts to get confusing, and typically Elliott wave analysts don't always get their Elliott waves right, and they make a lot of mistakes, and most people pretty much consider it junk, or a lot of people consider it junk. So let's take a look at this movement, this particular movement here with the surge. So we know that we had a pattern 2 right here with the stochastic cross right here. So we know that this is the start of the move here. And then if we take the next periodic spot of the surge oscillator, which is in this area right here, we'll see that was the first move, okay? And then if we define the second move to be the periodic move down on the oscillator, it finally reached a low point right here, and that corresponds to this point right here. So what it means is that the next wave was from here to here, and then the last wave was when the surge changed its direction and moved up to this level right here. So at this level right here was the top of the Elliott wave. So from the surge perspective, the Elliott wave, this was wave 1, this was wave 2, and this was wave 3. So the surge actually helped to define this Elliott wave in a way that's successful. Let's put it that way. It found that the top of the market was not this area here, but it was actually up here. What's interesting is that this particular Elliott wave, it didn't look like it was moving down for wave 2. It was actually moving kind of sideways up. But the fact is, this is a different direction. It went like this, like an S or something. But the top and the bottom was, though it wasn't down, it was still a different direction than the up move. So the wave looked like kind of more like not like a Z so much, but more like just like a jog or something, and then a move up. So what I mean is that Elliott waves, like I was saying, are like snowflakes. They do exist in this 1, 2, 3, but they're going to all look a little bit different. In this case here, the Elliott wave pattern, according to the surge, looked like this. This was actually a very similar pattern as the previous one. And then up here, that was the 1, 2, 3. So it was a very similar pattern to this one. And of course, we had a very obvious one on price coming down, 1, 2, 3. Okay, that's all I have for this video. Thanks for watching, and if this information helped you, Please like and subscribe, and please also share this video with your friends who might be interested in trading. Thank you very much. I'll see you in the next video.